the number one mistake that people make when applying for a loan. So you're going to want to stick around because we're going to talk about that one mistake, plus some other common mistakes people make as well. And we're also going to talk about why lenders are not all the same and why it's important to you and how it can impact your ability to get financing to buy your next home. Look, I know, having gotten a loan myself, that getting a loan can be a little scary and intimidating. Now, I've also been on the other side of that table because over the last 15 years, in addition to being a realtor, I am also a lender. So what I hope to do in this video is, one, help you avoid making those mistakes so you won't torpedo your chances of getting approved. Two, give you the confidence you need. And three, taking the mystery out of the process. If this is your first time to this channel and you are contemplating making a move to the Kansas City metro area and want to know everything there is about living in the Kansas City market, then subscribe to my channel by simply tapping on the bell below. That way you will be the first to get information about the changes that are taking place in the Kansas City real estate market. My name is Chris Pucci with the Living in Kansas City real estate team, and we get calls from people just like you every day. So look, if you're thinking about moving the next 9 days, 90 days, or even the next 9 months, please feel free to reach out. I can be contacted via phone, text, email, or better yet, schedule a Zoom call. Because there's nothing we'd like better than to help you make that smooth move to the Kansas City metro area. So, now that we've got the commercial out of the way, let's jump in. So the first mistake that people typically make, and that is, you gotta get approved, at least pre-approved, because a real estate agent worth their salt is not going to take you around and showing you houses, spending all that money on gas on their car, the wear and tear on their car, and then get a house under contract only to find out you can't close. They're just not going to do it. They're not going to jeopardize their reputation. The other reason why you want to get pre-approved is, two, you want to know that you can get financed. You want to know, hey, how much house can I really afford? And how much can I expect my house payments to be? As far as the process, it's really simple. It really takes about maybe 10 minutes. You're going to be on the phone with someone like myself or another lender. Typically what I'm going to do is I'm going to get a little better feel for what your goals and aspirations are. Is this your first home? Is this a forever home? Are we downsizing? What is it we're trying to accomplish? Get a feel for your lifestyle. And then we're going to figure out how much have you budgeted for a house payment. And from there, you get me all that information. I put it in the automated underwriting system. I have to generate a credit report. I hit the desktop underwriter button. And what we're looking for is an approved eligible. If we get that, it means that you've been pre-qualified for a loan. So the next step to get pre-approved is you're going to send myself or the lender you're working with all the information that they requested based on the conversation. You're going to use that information to verify our conversation. If we need to tweak the system a little bit, we can. Then once again, we hit the DU button and we're looking again for that approved eligible. Assuming we get an approved eligible, 95% of the lenders out there are going to give you that pre-approval letter, and you're about running around looking to get a house under contract. So you're going to be on the internet looking at homes, going to see homes, making offers. And in our market where there's multi offers on every property, it seems, you're going to probably lose out on the first 2 or 3 offers that you make till you finally get a house under contract. Here's the problem with that, and this is how I'm different. I don't give pre-approval letters out at that point because of this reason. The person who makes the final decision as to whether or not you're pre-approved for a loan is the underwriter. And who hasn't looked at your file yet? The underwriter. So here's what happens. What I call the old school way. You've got your house under contract. The underwriter is now going to see your file for the first time. And that's where the risk runs, where you might end up getting that Houston call. You know, hey, Houston, we have a problem, and the problem might be an easy fix. Or the problem can be fixed, but it's going to take longer than you thought, and it's going to push out your closing date, which could be a problem for a lot of people, including yourself. Or it could be a killer, we can't go forward. And don't think for a minute, those types of problems creep up. Despite how good the loan officer is on the front end, those little things sometimes cannot be foreseen. I'll give you an example. Had a borrower, went to the local bank. The local bank said, you're good to go. They had the house under contract, they sent the contract into the underwriter. The underwriter is looking at the file and goes, oh, we need a verification of rent. And I'm going to come back to this example later on in this video. Bottom line was, the borrower said, that's not a problem, we'll get one from our landlord. Well, the landlord sent this letter in and said, hey, this particular borrower that you're looking at has been habitually late when making their rent payments. Now, everyone could tell from their credit score and report that probably wasn't the case, but the underwriter could not really argue it. So she said, we got to deny the loan. So there's a case where the loan officer, the borrower, and everybody could not have anticipated that, but now they had a property under contract and they couldn't get it closed. We'll come back to that story towards the end, and I'm going to share with you how we fixed it. So that's the process. It really is simple, but again, where it's different is I don't give pre-approval letters out. My next step is I give the file to the underwriter, because the underwriter is the person who's going to determine whether or not you are going to qualify for a loan. So at that juncture, she'll come back and she'll say, hey, Chris, here are the conditions. They've been conditionally approved subject to these conditions. If there's a deal breaker in there, we're going to know about it before you've spent any time going out looking at homes. Secondly, if there's an issue, we can fix it now where we have the time to get it taken care of, and we have more latitude to get something resolved than when we get something under contract. The benefits are this. One, when you get all those conditions resolved, all you're waiting for is a contract, clean title, and an appraisal that supports the contract. You literally can make a non-contingent offer, giving you a significant advantage in the negotiating process, not only to outcompete other offers, but to potentially buy the home for a lower price. We took that even one step further, and we have what we call this simple purchase process. So if you're buying a home using a conventional loan, we will actually buy the house on your behalf from the seller all cash. And you can close then post our closing at a time that's a little more convenient for you. You then are truly a cash buyer in this instance, giving you significant leverage in the negotiating process. So that's how we handle the pre-approval process. Most just give you a letter and they hope there's nothing happens in the next 30 days or whatever, depending on what your closing is. So that's 30 days of restless sleep while you hope that there's nothing that creeps up that somebody didn't find. Number 2, don't open up a bunch of new accounts. That's the last thing you want to do, because your loan is tied to the debt-to-income ratio. And if you start opening up new accounts, 2 things can happen. 1, it can jeopardize your credit report, your credit scores. 2, it's going to impact your debt-to-income. So I tell folks, look, well, first of all, I don't just tell them. I email them and text them all 3 ways. Do not do anything like that unless you call me first, so we can have a discussion to see how it impacts your credit scores and your debt to income, and then we can figure out if there's a way that we can work that increase payment into your debt to income. So if you're down to have got to have a car or a house, if by all means you can hold off on the car to buy the house, you're better served than if you do it the other way around. It's really a simple process. Once you're in the loan process, just think of this. You're on a diet. You can't go out and spend a lot of money. And I know that's really hard when you're buying groceries these days, but that is the case. You really don't want to impact your debt to income. Another common mistake that people make, believe it or not, they'll either quit their job, I know, crazy, right? Or they change jobs. Now, I understand if you get laid off or you've got a great job opportunity and you had to pull the trigger right then, you didn't have the opportunity to wait, yeah, I get it. Now, with some lenders, that's going to be a problem. With others like ourselves, we have ways to work through that depending on what we can get from your new employer. Now, another change that can blow your loan up is, hey, I changed the way I get compensated. In most instances, this is not a big issue. But here's an example. Let's say you're a salaried And now you went maybe from a combination salary to commission, or you went to straight commission because it was a better situation for you. Well, when you submit your documentation to the underwriter, it has a lifespan of only so many weeks. So here's what happens. If you, let's say you're buying a house that's being built, and you started off the process at the beginning, you gave all the information to the underwriter, you're good to go. 9 months later, the house is ready. Now the underwriter wants updated pay stubs. And now you went from salary to commission. Well, guess what? With most lenders, you're toast, because you have to have at least 2 years of commission income before an underwriter can recognize it, because that is the guidelines. It's not an underwriter being arbitrarily adversarial. That's the guidelines. We do have some programs that would allow us to navigate past that, but I'm just telling you, when you're making these kinds of changes, it is imperative that you stay in communication with your lender so they can make the appropriate adjustments and prevent you from doing something that's going to jeopardize your getting the loan. So at this point, you've heard 3 of the more common things. We haven't talked about the number 1 yet, but let me know what experiences you've had in the lending process, or if you have any questions, let me know that as well. One other common, I think, a mistake that people make, they'll go, we'll start off and they'll say, hey, this is how much house I want to buy because this is what I want my house payment to be. So let's just say, for argument's sake, it's a $300,000 home. But let's also say, based on their income and their profile, they could actually qualify for a $500,000 home. Now, just because you can afford a $500,000 home doesn't mean you go out and buy a $500,000 home. I mean, you do want to enjoy your life. You do want to go on vacations or go out to eat occasionally. If you are maxed out on what you can afford, you may be in a position where you can't enjoy those types of things. Furthermore, on the first of the month when you're stroking that check to the lender, you're going to hate it. I counsel all my clients, tell me what you want to pay for a house payment. Let's work very hard to stay in that realm, because based on what you've told me, this is your lifestyle, and if we go too much beyond that, you're going to jeopardize that. So now we've come to the last and the biggest mistake that most people make, and that happens to be their credit. What people really do is they wait to the very last moment to have their credit checked. So here it is, now they want to go buy a house, they get in front of someone like myself, they've never had their credit looked at, and so when a credit report is generated, there could be an issue on there that they were unaware of, and it's not going to be a simple fix. It could take 30, 60 days or longer, depending on what the nature of the issue is. I always tell people, hey, if you're thinking about buying a house, it does not hurt to have a credit report generated 3 to 6 months in advance. And I know there's a myth that if you have someone pull credit, it's going to negatively impact your score. That's not true. There's one thing that a lot of lenders, including myself, do, and we'll do what's called a soft pull. It will not affect your scores, but it will allow us to see what your scores are and give us a really good idea what, if any, issues that we're faced with that we need to address. Just because you have marginal or bad credit doesn't mean you can't get a loan. Just means it's going to be maybe a few more hoops that we're going to have to jump through. We're going to have to find the right loan product to take advantage of your particular situation. Like most lenders too, we have programs that once we generate a credit report, we can actually go in and we can do kind of what ifs. Hey, what if this happens or what if that happens? How does that impact the credit report? Do the scores go up, which allows us to qualify for other programs or for a mortgage period? Those are just some of the things that lenders can do. So just because you've been told you can't get a loan here or there, don't believe them. Again, not all lenders are created the same. You can go to 3 banks and they can all tell you you don't qualify, and you can come to me and I can say, you know what, I have a program and you can qualify for that. So let's talk about that a little more detail. There are basically 4 types of lenders. You've got banks, credit unions, mortgage bankers, which I am, and mortgage brokers. We all have our pros and cons. We're all a little different. Banks and credit unions. If you have excellent credit and you're putting down, say, 10, 15, 20% or more, have a steady job, make really good money, you're their ideal client. And you're going to be treated very well, and you're going to get their best rate. And banks and credit unions typically have some of the best rates, not always the best, but they're always in the hunt when it comes to better rates. The problem with banks and credit unions, and even some mortgage bankers, is they don't go off the guidelines. So what do I mean by that? Well, remember when we put all the information in and we got the approved eligible? Well, behind that, we get what's called the findings. The findings are like a roadmap, and this is what the underwriter must follow for you in order to be approved for a loan. However, having said that, banks, credit unions, mortgage bankers, they can impose what we call overlays. So here's a simple example of an overlay. An overlay can be, hey, I go to bank A or credit union B. I want to get a conventional loan. I have, a 630 credit score. Conventional says you can potentially get a approval for a loan, for a conventional loan, if you have a 620 or higher credit score. So say I have a 630 and I actually get an approved eligible. The bank says, well, that's fine, Chris. You've got an approved eligible, you got a 630, but we will only loan to people with a 670 credit score. You can't get approved. You might go to 2 other banks and get the same response. Doesn't mean you can't get approved. It just means you can't get approved at those banks. But if you came to me, I have several programs that I could get you approved. And if you got an approved eligible at a 630 on a conventional loan, then assuming you can meet all the conditions, you're good to go. That's one example. So let's circle back to the poor souls who had the house under contract and were told, hey, we had to have a verification of rent, and because of that verification of rent, they couldn't get a loan. Well, here's what happened. The findings didn't restate that they had to have a verification of rent. The lender had an overlay and required that as part of their underwriting process. What happened is that agent called me up and said, Chris, can you take care of these folks? I said, what's the issue? Well, they got this verification of rent. The landlord torpedoed them, and now they can't get approved. So I said, let me see what we get. So I put it in the system, I got the approved eligible, I looked at the findings. The findings did not require a verification of rent, so we ended up closing the loan. That's just one example of what makes a lender who goes off the findings that much easier to get approved and close on your dream home than going with, say, a credit union or a bank. The bottom line is this. Mortgage bankers, mortgage brokers typically have more programs than banks and credit unions. Everybody does conventional, FHA, VA, which is a great program, as well as USDA. Those latter two are my 2 favorite loan programs. FHA is great because it has a higher debt-to-income ratio, so it allows you to buy more home, even with marginal or bad credit. Conventional, well, conventional is conventional. It's a little more lenient, particularly when it comes to the appraisal process. You also have access to a lot of what we call non-QM loans, like a bank statement loan or what they call a DSCR loan, which is a debt service coverage ratio loan. That's for investors. If you're buying an investment property and they don't look at your income or your job, they simply look at how much income are you getting and what is the loan payment going to be. And if you have at least a 1-to-1 ratio, you're probably good to go, assuming you have the credit score and the appraisal comes in. Now, some will even go down. Some lenders will go down to a 1.0. But you've got access to that. Bank statement loans, various investors. So maybe you don't qualify for a bank statement loan with investor A or B and C, but investor D works for you, so there you can get a loan. I literally just did a loan with a client that exactly happened. They couldn't find a loan anywhere. We ended up doing a bank statement loan with them. The first 4 or 5 investors I looked at, they didn't qualify for, but the 6th one worked for them, and they bought their nice brand new home here in the Kansas City metropolitan area. Here's the bottom line. Just because you're told by lender A or lender B you can't get a loan, hey, you've got a bankruptcy, you can't get a loan. That's not true. If you have a Chapter 13, you can get an FHA loan if you meet certain requirements. I've done a number of those. Just because you've been told by one bank or credit union, don't give up. You'd be surprised how many lenders, mortgage bankers or mortgage brokers can help you find a product that will get you into your new home. If you have any questions or you want to learn more, feel free to set up a time. We can chat. I'll be happy to answer any questions you have, and you can decide for yourself if there's any merit to talk in the future. All my information is below. You can contact me by email, text, voicemail, or better yet, schedule that Zoom call. So, having said all of this, thank you for watching the video. I hope you found it informative and beneficial. And until then, I look forward to showing you around the Kansas City metropolitan area.